Berlin, 1923. A woman pushes a wheelbarrow full of cash to buy groceries. Not because she's wealthy, because bread costs 200 billion marks. By the time she reaches the bakery, the price has doubled. Her life savings, enough to buy a house 5 years earlier, won't purchase a loaf of bread. Buenos Aires, 2001. A bank manager locks the doors at 10 a.m. Outside, thousands of middle-class Argentinians pound on the glass, screaming for their money. Inside the vault, their life savings sit untouched. But they can't access a single peso. The government has frozen every account. When they finally unlock the doors months later, 2/3 of everyone's wealth has simply vanished. Leningrad, 1919. A former countess trades her grandmother's diamond necklace for a sack of potatoes. The jewels that symbolized 3 generations of aristocratic wealth are worthless. The farmer who can't read accepts them only because his wife likes shiny things. The potatoes keep the countess alive for 2 weeks. 3 different centuries. 3 different continents. 3 different types of collapse. But one pattern repeats with mathematical precision. When systems fail, the same people survive. Not the smartest. Not the wealthiest. The ones who understood what wealth actually means when everything breaks. This isn't theory. This is pattern recognition across 2,000 years of recorded economic catastrophe. And the pattern is screaming at us right now. Every collapse follows the same sequence. First, the warnings appear, warnings that seem absurd to people living in the system. The Roman denarius loses silver content slowly over decades. Weimar Germany prints money to pay war debts. Argentina borrows in dollars while earning in pesos. The United States runs $36 trillion in national debt while the Federal Reserve creates $5 trillion in 2 years. The people living through it always say the same thing. This time is different. We're more advanced. We have better institutions. Our government won't let it happen. They said this in Rome. They said this in Weimar. They said this in Argentina. They are saying it in America right now. But the pattern never changes because mathematics doesn't care about sophistication. When debt exceeds the capacity to repay, something breaks. When currency supply explodes beyond productive capacity, purchasing power evaporates. When institutional trust collapses, paper claims become worthless. The only variable is timing. And timing is what kills most people. Here's what the 2,000-year pattern reveals. The people who survive don't predict the exact moment of collapse. They position themselves according to principles that work regardless of timing. The people who lose everything are waiting for certainty, waiting to know exactly when to act. By the time certainty arrives, it's too late. Let me show you what actually survives when everything else burns. In 410 AD, Alaric and the Visigoths sack Rome. The wealthiest city in the world falls in 3 days. Roman senators who own vast portfolios of grain contracts and shipping agreements lose everything overnight. The contracts are worthless because there's nobody to enforce them. But a farmer outside Rome still has a farm. The land produces the same wheat. The same olive trees bear fruit. The legal documents proving ownership might be gone, but the farm remains functional. This distinction between real assets and paper claims is the first thing the 2,000-year pattern reveals. Real wealth is anything with intrinsic value. It produces food, shelter, energy, or utility independent of any system. A farm grows food whether the Roman Empire exists or not. A building provides shelter regardless of currency. A tool performs work without institutional backing. Paper wealth is a claim on something else. A stock certificate is a claim on corporate earnings. A bond is a claim on future repayment. A bank deposit is a claim on the bank's promise. These claims work beautifully when institutions function. They become instantly worthless when institutions fail. The pattern shows this truth across every collapse. Germany, 1918 to 1923. If you held 100,000 marks in 1918, you were upper middle class. That money could buy a nice house in Berlin. By 1923, that same 100,000 marks couldn't buy a postage stamp. The currency inflated into toilet paper. Literally, people used mark notes for wallpaper because it was cheaper than buying wallpaper. But if you owned a small apartment building in 1918, you still owned it in 1923. The building housed the same number of families. It collected rent, even if the rent amount in marks became absurd. The building retained real value. The distinction isn't between good and bad investments. It's between assets that exist independently versus claims that depend on system functionality. Zimbabwe, 2000 to 2008. Hyperinflation reaches 79.6% monthly. Every Zimbabwean dollar becomes worthless. Bank accounts evaporate. Government bonds default. Stock certificates for Zimbabwean companies become novelty items. But agricultural land still grows tobacco. Cattle still produce milk. Mining equipment still extracts minerals. The physical assets continue functioning regardless of what happens to the currency. Here's the critical insight the pattern reveals. In stable times, paper claims are more convenient than real assets. A stock portfolio is easier to manage than a farm. A bond fund is simpler than rental property. Digital wealth is more liquid than physical wealth. This convenience makes paper wealth dominant during stable periods. Everyone optimizes for convenience. The entire financial system evolves to make paper claims easier, more liquid, more profitable than real assets. Then collapse comes, and convenience means nothing. The pattern repeats. Real assets survive because they don't depend on institutional promises. Paper claims fail because institutions break their promises, sometimes deliberately, sometimes because they simply can't fulfill them. Paris, 1789. The French aristocracy owns most of France's wealth, on paper. Land titles, noble privileges, annuities from the crown. Then the revolution comes. Every paper claim is repudiated. Aristocratic wealth evaporates overnight. But here's the twist. Some former aristocrats survive and even thrive. Not the ones who owned the most land on paper. The ones who knew how to make the land produce. The nobleman who actually farmed his estate had skills and production. The absentee landlord living in Versailles had paper and died broke. This reveals the second pattern. Productive assets beat speculative assets in every collapse. A productive asset generates value independent of price. A farm produces food. A workshop manufactures tools. A rental property provides shelter. The asset creates utility that people need regardless of economic conditions. A speculative asset only has value because someone else might pay more for it later. Land you bought to flip. Stocks you hold for appreciation. Cryptocurrency. Art as investment. These assets produce nothing. They are only valuable if you can find a buyer. In stable times, speculation outperforms production. It's easier to flip houses than manage rentals. Day trading stocks generates faster returns than operating businesses. Speculation becomes dominant because it's more profitable. Until collapse. Then speculation dies instantly. United States, 1929 to 1933. The stock market loses 89% of its value. People who own stocks for speculation are destroyed. The market went up for years, they made paper fortunes. Then it crashes and there are no buyers. The paper fortune vanishes. But people who own productive assets directly, farms, businesses, rental properties, maintained income streams. A dairy farm still produced milk. People needed milk even in the Depression. The farmer's income dropped because milk prices fell, but income continued. Production didn't stop. Compare this to someone who owned dairy company stock. The stock became worthless. No income. No production. Just a paper certificate nobody would buy. Venezuela, 2010 to 2020. The stock market rises 100,000% in bolivars. This sounds incredible until you realize the bolivar lost 99.9% of its value. Stock market gains were worthless. But productive businesses survived. A bakery still baked bread. People desperately needed bread. The bakery owner faced shortages, government interference, and chaos, but the business produced value. Production meant survival. Contrast this with Venezuelan government bonds. They paid interest in worthless bolivars. They had no productive capacity. They were pure speculation on government solvency. The government defaulted. Bondholders lost everything. Here's what the 2,000-year pattern reveals about production. When systems collapse, only production matters. The ability to create food, shelter, energy, goods, or essential services is real wealth. Everything else is gambling on system stability. Most modern wealth is speculative. The S&P 500 doesn't produce anything. It's a claim on 500 companies' production. Bitcoin produces nothing. It's speculation on future adoption. Most real estate is speculative, bought for appreciation, not rental income. This works perfectly until it doesn't. The pattern shows that productive assets provide survival income when speculation fails. Iowa, 1933. A farmer named John watches the bank auction his family's 400-acre farm. His grandfather cleared this land in 1870. His father expanded it in 1900. John has farmed it his entire life. Now it's gone. Why? Debt. John borrowed $15,000 in 1925 to buy modern equipment and 100 more acres. Land prices were rising 10% annually. Borrowing made perfect sense. The debt would pay itself off as land appreciated. Then 1929 hit. Corn prices collapsed 63%. John's annual income fell from $4,000 to $1,500. But the debt payment didn't change. $2,400 annually, due regardless of income. John couldn't pay. The bank foreclosed. 3 generations of family wealth evaporated because of 5 years of debt. 3 miles away, John's neighbor Carl still farms his 200 acres. Carl is struggling too. His income also fell 63%. But Carl has no debt. He owns his land free and clay. He's poor, but he's not homeless. His children will inherit the farm. This is the third pattern collapse reveals. Debt destroys in crisis, even good debt. In stable times, debt is leverage. You borrow to buy assets, assets appreciate, you profit. The math works beautifully when incomes stay steady and asset prices rise. But collapse breaks both assumptions. Income falls or disappears. Asset prices crash. The debt remains unchanged. You can't pay, so creditors seize assets. Wealth you spent years building vanishes in months. The pattern repeats across every collapse. Argentina, 2001. Middle-class families hold mortgages denominated in US dollars. This seemed smart. Dollar-denominated rates were lower than peso rates. Everyone did it. Then crisis hits. The peso loses 66% of its value overnight. A family earning 3,000 pesos monthly saw their income fall to the equivalent of $1,000 in dollar terms. But their mortgage payment stayed at $800. Before the crisis, 800 out of 3,000 peso income, manageable. After the crisis, 800 out of $1,000 equivalent income, impossible. Foreclosure rates exploded. Families lost homes they'd been paying on for 15 years. Meanwhile, families who owned homes outright kept their homes. Same income drop, same crisis, but no debt meant no foreclosure. Greece, 2010 to 2015. Incomes fell 30 to 40%. Pensions were cut 50%. But mortgages didn't decrease. Greeks borrowed heavily during the boom years. It made sense when incomes were rising. When incomes collapsed, debt became unbearable. Default rates spiked from 5% to over 40%. Here's the counter-argument. But inflation helps debtors. If you owe $300,000 and get 20% inflation, your real debt burden drops. This is technically true but practically false in most collapses. Here's why. Inflation helps debtors only if incomes keep pace with inflation. If bread costs twice as much but you earn twice as much, debt becomes easier to service. But in real collapses, incomes don't keep pace. Prices rise faster than wages. You get the worst of both worlds, inflated costs but stagnant income. Weimar Germany proves this. Yes, debtors could pay off marks-denominated debt with worthless marks. But most people's debts were foreclosed before hyperinflation peaked because they lost income during the initial crisis phase. By the time hyperinflation made debt worthless, they'd already lost their assets to foreclosure. The pattern reveals this truth. The only safe position is zero debt. Own assets free and clear. If you have a mortgage, you don't truly own a house. You own a leverage bet that house prices stay high and your income stays steady. If you own a house outright, you own a house. Period. No bank can take it. Debt is expansion during stability. Debt is suicide during collapse. Vienna, 1938. A Jewish surgeon named Dr. Adler owns a large medical practice, an apartment building, and significant savings. On paper, he's wealthy. Then the Nazis arrive. In 3 months, everything is confiscated. Practice seized. Building taken. Bank accounts frozen. The family flees to Switzerland with nothing but what they can carry. Dr. Adler arrives with no money, no property, no assets. But within 6 months, he's practicing medicine again. Within 5 years, he's rebuilt a comfortable life. His skills came with him. Everything else was taken, but skills remain in your brain. Meanwhile, his neighbor Herr Schmidt, a wealthy merchant who owned 3 shops, arrives in Switzerland with nothing and has nothing to offer. He owned businesses but never learned to produce anything himself. He starves while Dr. Adler thrives. This is the 4th pattern. Skills are the only truly portable wealth. Every other form of wealth can be seized, taxed, inflated, confiscated, or lost. Land can be taken. Gold confiscated. Money inflated. Businesses nationalized. But skills live in your mind. They cross borders. They can't be taxed away or stolen. Soviet Union, 1917 to 1922. The Bolsheviks seize all private property. Aristocrats who owned estates spanning thousands of acres lose everything in a single decree. A count who owned 50,000 acres is suddenly homeless. But engineers survive. Doctors survive. Skilled workers survive. The Soviet state needed them. Their skills gave them value even under communism. The aristocrat who owned land but couldn't work it starved. The blacksmith who owned nothing but could forge tools survived and eventually thrived. Vietnam, 1975. When Saigon falls, millions flee. They can't take property. They can't take businesses. The Vietnamese refugees who rebuilt most successfully in America had one thing in common: skills. Doctors, engineers, accountants, mechanics, teachers. They arrived in California with nothing but knowledge. Within a generation, many built successful middle-class lives. Their skills transferred. Their wealth was portable. Meanwhile, Vietnamese people who were wealthy in Saigon, property owners, business owners, but had no skills struggled in America. Their old wealth didn't transfer. They had to start over from zero with no portable skills. Here's what the 2,000-year pattern reveals about skills. In every collapse, physical survival comes first. Then rebuilding begins. Skills determine who rebuilds successfully. But most modern wealth is locked in non-portable forms. Your retirement account can't cross borders easily. Your house stays where it is. Your business might not survive system collapse. Skills are the only guaranteed portable wealth. Yet most people develop no practical skills. Can you grow food? Preserve it? Fix machines? Build structures? Provide medical care? Make clothing? These skills produce value for 10,000 years. They'll produce value after the next collapse. Modern specialization is efficient but fragile. You're extremely good at one thing that requires complex systems. When systems fail, your specialized knowledge might become worthless. But practical skills, producing food, energy, shelter, health, remain valuable in every scenario. Moscow, 1998. The Soviet Union collapsed 7 years earlier. The currency is worthless. Pensions stopped. Supply chains broke. Grocery stores are empty. The government exists on paper but can't govern effectively. By every measure, Russia should be in chaos. Starvation. Violence. Societal breakdown. But Russians survive. Not through government assistance, the government is dysfunctional. Not through markets, markets barely function. Through local networks. Families share resources. Neighbors trade. Communities organize security. A doctor treats patients for food. A mechanic fixes cars for vegetables. A teacher tutors children for firewood. These informal networks become more important than any institution. The people who survive best aren't the wealthiest. They are people embedded in strong local networks. The isolated individual with money in a closed bank starves. The connected person with relationships survives. This is the fifth pattern. Local trust networks outlast all institutions. When systems collapse, institutions fail. Banks close. Governments lose authority. Police can't enforce laws. Courts are overwhelmed. The entire institutional framework that modern life depends on simply stops functioning. But local networks of trusted relationships survive. These networks predate institutions. They'll exist after institutions fall. Argentina, 2001 to 2002. Banks close. The government is dysfunctional. Police can't maintain order. For 6 months, Argentina barely has a functioning state. But neighborhoods organize. Asambleas barriales, neighborhood assemblies, form spontaneously. People organize locally to barter, share resources, provide security. These informal networks become more important than government. People embedded in these networks survive. They trade skills for food, labor for goods, trust for mutual aid. The socially connected thrive while isolated individuals struggle. Lebanon, 2019 to present. The Lebanese pound loses 90% of its value. Banks close, they literally won't let people access their own money. The government is paralyzed. Infrastructure crumbles. By every metric, Lebanon should be in catastrophic collapse. But Lebanon hasn't descended into chaos. Why? Because Lebanese society is organized around family and religious community networks. These networks provide what the government doesn't: food distribution, security, financial assistance, healthcare. Here's what the pattern reveals about trust networks. Before modern institutions, all economic activity happened through local trust. You traded with people you knew. You borrowed from people who knew you'd repay. Your reputation was your credit score. Modern institutions scaled beyond local trust. You can trade with strangers across the world because institutions enforce contracts. You can borrow from banks that don't know you because institutions assess credit risk. This works beautifully until institutions fail. Then we revert to pre-institutional economics. Trust networks become everything. In America 2025, most people are institutionally embedded but locally isolated. You have a bank account but don't know your neighbors. You rely on Walmart for food but don't know local farmers. You trust police for security but don't know your neighborhood. This is catastrophically fragile. When institutions fail, and the pattern suggests they will, you have no fallback. No network. No relationships. No trust to draw on. The person with strong local networks will trade skills for food. The isolated individual will discover that money doesn't work when institutions fail. Notice what these 5 patterns have in common. They don't require predicting exact timing. You don't need to know whether collapse comes in 2027 or 2037. You position yourself according to principles that work regardless. Own real assets instead of paper claims. If the system stays stable, real assets appreciate and generate income. If it collapses, you own things with intrinsic value. You can't lose by owning farmland or rental property free and clear. Own productive assets, not speculative ones. If markets stay healthy, productive assets generate income. If markets collapse, you still have production. A farm that grows food works in both scenarios. Eliminate debt. In stable times, you have financial resilience. In collapse, you survive while debtors lose everything. Zero debt is optimal in both scenarios. Develop practical skills. In stable times, skills increase income. In collapse, skills become your only portable wealth. Learning to fix things, grow food, or provide essential services pays off regardless. Build local trust networks. In stable times, you have community and quality of life. In collapse, you have survival infrastructure. Strong local relationships improve your life now and protect you later. This is the genius of pattern-based thinking. You don't need perfect timing. You position according to what survives collapse, and you're protected regardless of when it comes. Most people make the opposite mistake. They wait for certainty. They want to know exactly when to sell stocks, when to buy gold, when to leave cities. They are waiting for the signal to act. But collapses don't announce themselves. By the time everyone knows collapse is coming, it's too late. Bank runs happen because everyone tries to withdraw simultaneously. Currency collapses happen because everyone tries to sell simultaneously. The pattern reveals this. The time to position yourself is before certainty arrives. When things still seem mostly normal. When your friends think you're paranoid. That's when positioning is possible. Once everyone agrees collapse is imminent, positioning becomes impossible. Try buying farmland when everyone else is too. Prices spike. Try building local networks during crisis. People don't trust strangers during chaos. Try developing skills when you're focused on daily survival. There's no time. Here's what the 2,000-year pattern reveals about America right now. The warning signs are identical to previous collapses. Debt exceeds productive capacity, just like Rome, Weimar, Argentina. The U.S. national debt is $36 trillion. Total debt, government plus private, exceeds $90 trillion. Annual GDP is $27 trillion. The math doesn't work. Currency creation is accelerating. The Federal Reserve's balance sheet went from $800 billion in 2008 to $9 trillion today. $5 trillion was created in just 2 years during COVID. This is the same pattern that preceded Weimar, Zimbabwe, Venezuela. Print money to solve problems. It works until it doesn't. Institutional trust is collapsing. Trust in government, media, corporations, even science is at historic lows. This matters because paper wealth depends entirely on institutional trust. When people stop believing institutions will honor their promises, paper claims collapse. The response to this is always the same. This time is different. America is the reserve currency. We have the strongest military. The dollar is backed by the full faith and credit of the U.S. government. They said equivalent things in every collapse. Rome was eternal. The British pound was backed by the empire. The Argentine peso was stable for decades. Institutional confidence is highest right before collapse because if people saw it coming clearly, they'd act to prevent it. But mathematics doesn't care about confidence. When debt exceeds the capacity to service it, when currency creation exceeds productive capacity, when trust erodes, collapse follows. The timing varies. The outcome doesn't. Here's what you need to understand. The collapse might not look like Weimar or Zimbabwe. It might not be hyperinflation. It could be a deflationary spiral like the 1930s. It could be a currency reset. It could be a slow grinding decline over decades. But the principles remain the same regardless of the specific form collapse takes. Hard assets survive whether it's hyperinflation, deflation, or currency reset. A farm is a farm. A building is a building. Physical reality persists regardless of monetary chaos. Productive assets generate value in every scenario. A farm that grows food produces value whether the dollar exists, hyperinflates, or gets replaced by digital currency. Debt destroys in every collapse type. Whether it's deflationary or inflationary, debt makes you fragile. The debt-free survive. The leveraged are wiped out. Skills transfer across any system change. A doctor remains valuable whether we use dollars, Bitcoin, or seashells. Skills transcend monetary systems. Local networks matter when institutions fail, regardless of why they fail. Whether it's hyperinflation, depression, or political breakdown, local trust networks provide the foundation for survival. The mistake most people make is trying to predict the specific collapse type. They want to know, will it be inflation or deflation? Should I buy gold or hold cash? These questions assume you can time it perfectly. You can't. Nobody can. Even the people who predicted the 2008 crisis couldn't time it precisely. Most were years early and lost money being right too soon. The pattern-based approach doesn't require timing. You position according to principles that protect you in multiple scenarios. This isn't about getting rich. It's about not losing everything. Because here's what the 2000-year pattern reveals most clearly. In every collapse, most people lose everything. Not because they were stupid. Not because they weren't paying attention. Because they followed the tactics that work in stable times. They held wealth in paper because paper was convenient. They speculated because speculation was profitable. They used debt because leverage amplified returns. They specialized because specialization paid more. They trusted institutions because institutions had always worked. Every single one of these tactics makes perfect sense during stability. Every single one becomes catastrophic during collapse. The people who survive understand this distinction. They sacrifice some convenience, some profit, some leverage during stable times to ensure survival during collapse. They own farms instead of farmland rights because farms produce food regardless of institutional function. They own rental property free and clear instead of leveraged real estate portfolios because debt-free property can't be foreclosed. They develop practical skills instead of only specialized knowledge because practical skills transfer to any system. This feels like over-preparation during stable times. Your friends think you're paranoid. Financial advisors tell you you're leaving money on the table. You watch others get rich on leverage and speculation while you own boring productive assets debt-free. Then collapse comes. And suddenly your position makes sense. While everyone else scrambles, you're positioned. You have hard assets while paper burns. You have productive capacity while speculation fails. You have zero debt while others face foreclosure. You have skills while others have nothing portable. You have local networks while isolated individuals struggle alone. The 2000-year pattern is crystal clear. These 5 principles worked in Rome when gold was currency. They worked in Weimar when paper was currency. They worked in Argentina during currency crisis. They worked in Russia during system collapse. They worked in Vietnam during war. They will work in America. The only question is whether you'll position yourself according to these patterns before the window closes, or whether you'll wish you had after it's too late. Because timing is impossible to predict. But patterns are impossible to ignore. Rome fell over centuries. Weimar collapsed in 5 years. Argentina crashed in months. Zimbabwe hyperinflated in weeks. The speed varies. The pattern doesn't. And right now, America is following the exact same pattern. Debt exceeding capacity. Currency creation accelerating. Institutional trust eroding. The warning signs are all present. You can't predict when. But you can position for survival. Own real assets, not paper. Own productive capacity, not speculation. Eliminate debt completely. Develop practical skills. Build local trust networks. These 5 principles survived 2,000 years because they're true in every economic system. They worked when gold was money. They worked when paper was money. They'll work when digital is money, or when money itself breaks down. The people who follow these principles don't need to predict the future. They are prepared for multiple futures. Whether we get hyperinflation, deflation, currency reset, political breakdown, or slow decline, the principles protect you. The people who ignore these principles are making an enormous bet. They are betting that this time really is different. That America won't follow the same pattern every other empire followed. That our institutions are somehow immune to the mathematics of debt and currency debasement. Maybe they are right. Maybe this time really is different. But 2,000 years of pattern recognition suggests otherwise. And the cost of being wrong is everything. If this showed you that patterns matter more than predictions, that the same 5 principles have survived every collapse in history, and that you can position right now without needing to know exact timing, subscribe, like, comment. Because the next video breaks down the specific tactics for 2026 America. Which hard assets make sense in a digital economy? Which productive assets generate value in modern markets? How to eliminate debt strategically without destroying your lifestyle? Which skills are most valuable when systems fail? And how to build local networks in an isolated society. The principles tell you what survives. The tactics tell you how to apply them. These 5 patterns worked in Rome, in Weimar, in Argentina, in every collapse. They'll work in America. The only question is whether you'll position yourself before the window closes, or whether you'll wish you had after it's too late.